Let's bring in Diana Avigdor. She's portfolio manager and head of trading at Barometer Capital. She's standing by to tell us what's been happening. Diana, thanks so much for joining us. And let me just ask you, what's the mood right now, given this incredible sell-off we've seen in the past few hours?
The mood this afternoon is a little better than this morning, but it was very disappointing to come in this morning, and yesterday's rally did not hold. We had an extremely great rally yesterday at the close, and right off some important technical levels. We come in this morning and it did not hold. So the economic data came in line, and some comments out of Trichet just started the pendulum moving lower and lower. There's lots of factors at work, with the U.S. Really insisting on airing their dirty laundry, and Europe not quite okay. The risk-off trade, like you said, is going on. And mutual funds, long-only holders that have stayed put up until now, are feeling the pinch and feeling like they need to raise some cash. So we've been seeing some of that.
Diana, are we looking at the sort of a capitulation day of some sort, or is this something that you think is the start of maybe a long downtrend?
It's been pretty orderly. You look at the VIX, for example, where it's trading. It's been going in an orderly fashion. It hasn't been very panicky. The volumes are higher in the last few days, so some people might say it could be capitulation. It doesn't feel like it. It does feel like it could go lower. The S&P future pits, for example, at some point today, were only quoting in whole dollar increments. That indicates lack of liquidity for them. That's why they kept quoting in dollars. So there wasn't that much liquidity going on. And though the numbers you do see elevated volume numbers, a lot of that is in ETFs and the leveraged reverse ETFs. So not necessarily in the single stocks.
That's really interesting that's where we're seeing the volume right now is on the ETF trading. Is that amplifying the volatility that we're seeing right now because ETFs exist where they didn't years ago?
Well, this is what's happening when the stock markets are selling off like this and the VIX is elevated. The correlations between the stocks goes up. So everything is trading in the same direction. Everything is the same trade. So it does not pay to pick stocks, and also you're not really winning alpha by picking the stock. So if you wanted exposure on or exposure off, it's easier and faster to just do it in the ETFs. In addition, there's been some as technicals are breaking, and in the context of yesterday's rally, a lot of people have taken profits on their hedges, let's put it that way, or they said, everybody was saying that it was oversold yesterday. Well, now the balanced market exposure funds need to re-hedge that. So there's been an incremental new hedger in the market, and the investment banks need to hedge that. So it just kind of self-perpetuates.
Diana, have we seen a fair amount of margin calls, and is that why we're seeing gold sell off, because investors need to raise some cash?
I don't have an answer to that question because I haven't checked into that. I haven't heard, just anecdotally, any kind of major margin calls. The only margin conversation that we have heard today is on the gold futures. There is some chatter that they're going to be raising the margin requirements on those, but I haven't heard of squeezes. There always is chatter of funds that are not doing well and needing to raise some cash, but like I said, we haven't seen that in a particular sector, so it's kind of broad-based. I have seen some buy baskets, people with portfolios attempting to take advantage of better prices. But, from a trader's perspective, it doesn't pay to try and pick the bottom.
Yeah, no kidding. Let me ask you two things you've mentioned, Diana. I want to ask about mutual fund holders and increased margin requirements on gold futures. Is that going to slow down the ascent in gold that we've been seeing in the past little while?
I don't. The short answer is I don't believe so. The gold market is a big market, and it's got a lot of depth. Much more than the silver market, when we've seen the margins go up there a couple of months ago, and it really hit the silver market. But there is money around that's looking for security, and you've seen that money in the Swiss franc, and you've seen that money in the yen, and then the Bank of Japan intervened, and the Swiss bank intervened as well to stop the strength of their currency. So that safety money needs to find a home, and you've seen gold rally the last couple of days a lot as money came out of those safe currency trades into some other safety basket, which is gold. So we're down $8 on gold, I think, when I left the office. That's not a big deal.
Let me ask you as well, you mentioned that you're seeing some mutual long-term funds and mutual fund holders getting out of the market. Again, that makes me a bit nervous when you tell me that. What does that tell you?
We've had mutual fund outflows, but if we put it in the context of the last 6 months, mutual funds have not been so fully invested. So they were able to handle the recent sell-off up to a point as mutual fund flows stall or move down and the stock's value move down. They feel that they need to take some more risk off. Up until now they were comfortable, but as technical levels break, they need to participate somewhat.
And Diana, the stock market is considered a forward-looking indicator. What's it telling us? That we're heading into recession? Are we anticipating terrible job numbers tomorrow? What's it telling us?
That's an interesting question, because we've had some conversations on that on trading desk as to, given today's trading, how much of the stock market predictive ability have we kept? You know, it used to be that it used to give you a lead time of 6 months to a recession. Back in 2007, 2 months before everything stopped, market was at a high. So given the high frequency trading, given the speed of information flow, how much of this predictive ability have we kept in the stock market? I think the time has certainly shortened. But I think also that it has lagged the economic data. And because of corporate earnings have been very good, and that's kept the market up. But now everything is macro, and I think the market is pretty much catching up with the economic numbers that we've seen lately. If we close at our lows today, it's entirely possible that we're going to have a non-farm payroll number tomorrow that might be a little light or in line. If better, even better, but we might just be pricing that in ahead.
I guess that was actually what I was going to get to, is what do you expect to see tomorrow again? If we, let's say, closed in around where we're trading right now, we had that little rally near the end of the day yesterday. What are you bracing for tomorrow?
You know, this is clearly pricing in a negative number. So I think that it's entirely possible that we have a little rally if it comes in line.
All right, well, we can hope to see that again if you're along the market.
But markets are definitely in treacherous territory. And like I said, from a trading perspective, it doesn't pay to try and pick the bottom.
Yep.
And it's entirely possible that we're going a little lower in the short term, so be careful.
All right, Diana, thanks so much for joining us.
Thank you.
Diana Avigdor, she's Portfolio Manager and Head of Trading at Barometer.